Hey guys, welcome to Business Math. Here reading your comments, and thanks for making them today. Um, Logan and Jacob, well, hopefully I'll be reading them later then. Um, and yeah, I like your opinions, everybody here. Thank you for sharing again. And I do agree with a lot of what you guys said. There's a lot of good thoughts behind what you're saying there. Um, yeah, I mean, people do have a good reason to, kind of panic, but at the same time, you gotta trust that God's in control of it ultimately there. Um, there is some, scary data out there. Was looking at the headlines, the number of patients in Pennsylvania that have had been diagnosed with this coronavirus doubled today. Okay, we're up to 560 in just a day. 560 more, so we're over 1,500 cases. Fortunately, no more in Cambria County, but I'm sure that will change. Um, and because of this, we have a record-breaking 3.3 million Americans uh, applying for unemployment. Okay, which is uh, we're already at 5.5% in unemployment, which is a number that wasn't around since 2015. So the unemployment rate's gonna surge, and hence why they passed that 2.2 trillion dollar stimulus. A lot of money. But at the same time, the economy is basically going to be shut down for at least another couple months before it's in full swing, maybe even more. And that's going to cost a lot of money and a lot of people money. So it's going to be drastic to repair it. Um, yeah, and just giving out that much money to people, well, it might cause futuristic inflation rates because we are basically giving out a lot of money and going further in debt. But right now, people can't afford stuff, so there's actually probably going to be a deflationary period, and actually there already is. The They've cut the interest rates like pretty much down to zero. Okay, so that's pretty crazy, the change there. Um, Anyhow, back to what we were talking about the other day. These investments. Okay, so the main reason why you want to invest in the stock market is to beat inflation and to, really grow your wealth more than you can earn just by working a job unless you get a really high paying job. So let's do a quick comparison using the rule of 72. Remember, you take 72 divided by the annual percent gain on your investment. So if you were like in a good performing savings account and getting 2% interest, okay, that would be 72 divided by 2. So it would take you 36 years for your money to double, okay? Compared to if you're in, the stock market wasn't doing so well, but you're still able to get 8% interest on average per year out of it. That would only take 9 years for your money to double, okay? So that's a big difference there. So like say we start investing at the age of 22, okay? So um, all right, so basically your money would double when you're 58. If you invest at 22, you're up to $2,000. And if you say retire at 65, you might get another 1,000, okay, but it won't double twice. However, if it doubles every 9 years, okay, so you start out with $1,000, okay, so 9 years from 22 would be 31, that'd be $2,000, okay, at 39, that would double again, so now you'd be up to $4,000 at the age of uh, that'd be 40, doubling every 9 years, so 48. Okay, we're up to $8,000. Um, and then see the picture here? It definitely causes your money to be able to grow a lot more rapidly. So you're up to $16,000, and then we double again, and so you're at 65. Okay, and you're at $32,000. So your money has went from a multiplied by 32 times versus doubled. Okay, and that is essentially in a nutshell why you want to invest. Okay, because who wants to just double their money when they can multiply it by 32 times? Okay, it's crazy the difference that it makes there. All right, so we were talking about places and things that are risky and least risky to invest in. I wanted to clarify here. When I said mutual funds was number 4 on our risk assessment scale here, I was talking about stock mutual funds. Okay, so that's like there are mutual funds that have some bonds in it, and so those are less risky than stock mutual funds. One other thing to point out is if you're wondering about gold and silver, that's a definite high risk investment. And government bonds, they're also called treasuries. You'll hear them called treasuries a lot. Okay, so today we're going to focus on what mutual funds are. A mutual fund is just a collection of stocks, bonds, and cash, and it could be other assets too, like real estate too. And it's controlled by a management company. Most mutual funds are actively managed. Some are passive, and they just track like a index of a collection of different stocks. ETFs are kind of a more modern version of a mutual fund. It's an exchange traded fund. And you can actually trade these actively. Mutual funds, you have like a day or two delay before you can buy and sell them. Exchange traded funds, you can buy and sell just like you would a stock on a click of a mouse or two. Okay, they're more passive, which means that they are generally not managed by people. They're just more like a collection of stocks or bonds. And because of this, they have usually lower fees. And historically speaking, active management, when you have other people watching your money, doesn't necessarily mean you will get higher returns than if you were just to invest in the stock market at large there. So that's kind of a debatable thing. So anyways, here is a mutual fund that I actually used to invest in. It is a combination mutual fund. It's called Wellington. It's a Vanguard fund. And it's, you see, asset class, that's like, is it stock? Is it bond? It's balanced. It's actually 66% stock, roughly, and 33% bonds in it, okay? So it's less risky than being in an all-stock mutual fund. But it was a little bit too much bonds for me, so I got rid of it. And so one of the main things that I'm primarily invested in currently is in this ETF, this exchange traded fund, because the expenses on it are basically nothing. Okay, so every year they take 0.03% of the fund, and it goes towards expenses. Wellington, this one has like 8 times the amount of expenses for it, but it still is relatively low. Anything under 1% going to expenses is pretty good. So what does this S&P 500 invest in? Well, it invests in all 500 U.S. companies that are the largest U.S. companies, okay? And so I'm like buying all the companies with one exchange-traded fund, okay? And you see they have like a risk scale here. They put it at a number 4. If you were to buy, like, say, small caps or international stocks, it would be more risky at a number 5. Wellington, they would probably have at a number 3 because you have so much more bonds in it. Okay? So if you take the mutual funds and you want to split them up by risk, the most risk would be all stock mutual funds. Okay? With all stock mutual funds, you can expect to get around, 8 to 10% per year estimated. Okay, gain. Now, of course, you can lose money on it. Like this year, I might be down 20% on it, but next year it might go up 20%, and so it kind of balances it out. And then you have what they call balanced funds or blended funds, which are some stocks, some bonds, and you could also have mutual funds that are what they call junk bonds, which are not really good trustable companies. They're companies that are kind of more risky, but they have more reward with it. They have mutual funds that are corporate bonds. So instead of like buying bonds for like one company, a mutual bond fund is a collection of many companies managed by somebody. Okay, and so it has less risk than investing in one particular company. And then you have government bond mutual funds, which have a collection of different, basically loans to the government. Okay, and you could buy individual government bonds. Okay, but if you the disadvantage about doing that is you're kind of more set into a fixed earning rate. With a government bond mutual fund, the earning rate will vary, and it's more liquid. You can exchange them as you please. They're better for long-term buying and purchasing. You don't want to just buy them willy-nilly, because the price on government bond mutual funds tends to vary, just like on the stock market. So they are least risky because they're generally not going to lose a lot of money, but you still might have a couple down years when the stock market does exceptionally well, because bonds and stocks actually work in opposite. When the stock market goes up, the bond market usually drops down in price and vice versa. So like right now, the bonds are actually going up in price. The percentage that you get on them is actually falling because they're dropping the interest rate, but the price for a bond fund is actually going up. So in the end, it kind of balances itself out there. It's a little confusing, but basically we'll talk about that maybe in another lesson. Don't want to linger on that too much. So mutual funds in your portfolio, you want to kind of split your money up between stocks and bonds, and they call that your asset allocation. Okay, that's like how your stocks and bonds are divided up. Okay, and so there's a website here that has like a bunch of different varying asset allocations, and you can see how the portfolios do. This is historical data from 1926 to 2018. Okay, so if you were 100% bonds, your average return would be 5.3%. Okay, it shows you what the worst year was, which was -8%, and what the best year was. Okay, so that's 100% bonds, and that's the least risk in terms of asset allocation. And then they have like increasingly like more stocks, less bonds. So let's look at 50-50 here. 50% stocks, 50% bonds. So you're up to about an average return of 8%, 8.2%. So that's about 3% higher than being 100% bonds. The best year, 32%. Worst year, 22%. You lose 22% of your money. 1931. That was Great Depression era. Okay? So more risk, but more return. And then, if you want to be really aggressive, you could go 100% stocks. Okay? And you can see at 100% stocks, you have about 2% more than 50-50 in terms of an annual average return. So you're up to 10% on average. And you could lose, worst case scenario, maybe now, okay, you can lose roughly half of your money, 43%, okay? But the best year went up 50%, and that was right after the Great Depression, okay? So it's crazy, the variation in the stock market. That's why you don't want to just dump all your money in at one particular time. You want to kind of spread out your investments. All right, so we'll talk about more strategy for, like what should your asset allocation be? Part of it has to do with your age, and we're going to talk about that maybe in the next video that I send you guys. But just remember, more stocks, more risk, but more return. Okay, so that's a key thing to keep in mind there. And yeah, mutual funds are a safer bet to go with, and ETFs are particularly attractive because they have very low expense ratios, and you could buy an ETF with only $100 easily. Mutual funds usually have higher minimums. Okay. Anyways, have a nice day, guys. Take care now.